I'm Mark Crumpton. You're watching Bloomberg Technology. Let's start with first word news. 2 days after he stunned the political world by defeating Hillary Clinton, President-elect Donald Trump met privately with President Obama Thursday in the Oval Office. Both men sought to set aside the divisiveness that rocked the nation and led to their own bitter personal interactions.
This was a meeting that was going to last for maybe 10 or 15 minutes, and we were just going to get to know each other. We had never met each other. I have great respect. The meeting lasted for almost an hour and a half, and it could have, as far as I'm concerned, it could have gone on for a lot longer.
The president said he was encouraged by Mr. Trump's willingness to work with his team during the transition. Later, the president-elect and his wife, along with Vice President-elect Mike Pence, met with House Speaker Paul Ryan, who had a strained relationship with Mr. Trump during the campaign. The president-elect also held talks with Senate Majority Leader Mitch McConnell. Iraqi troops have slowed their advance into Mosul while they regroup and clear neighborhoods reclaimed from Islamic State. The mission to retake Iraq's second-largest city is now in its third week. Kurdish fighters are holding the north while Iraqi troops approach from the south. Coalition airstrikes have been reduced because of the risk to civilians trapped in their homes. In New York, I'm Mark Crumpton. Bloomberg Technology is next.
And this is Bloomberg Technology. Coming up, the Dow celebrates a record high, but tech wasn't invited to the party. We'll dig into why technology is the only sector getting hammered since Donald Trump won the election. Plus, a disturbance in the force at Disney. We'll hear from CEO Bob Iger later this hour on the disappointing fourth quarter results. And exploring the unknowns as Silicon Valley braces for a Trump presidency. My exclusive interview with BlackBerry CEO John Chen and whether Trump's policies could lead to a trade war with China. But first, to our lead. The Dow Jones Industrial Average surging to an all-time high off the back of Donald Trump's election victory. But one industry is missing out. That's the tech sector. The so-called FANG stocks, Facebook, Amazon, Netflix, and Google's parent Alphabet, all down for a second day. One explanation may be that investors are weighing the impact of Trump's overseas trade policies on big tech multinationals. Joining us now to put the industry moves into perspective, our Bloomberg News stocks reporter Joseph Scioli in New York. Joseph, Apple also ending the day down almost 3% today. Walk us through the market moves.
Yeah, so really what you saw today were the companies that are going to benefit from a Trump presidency doing quite well, like industrials, materials, and financials. But on the other side, you have tech. You just mentioned it. There's a lot of internationally exposed companies in the tech sector. If you look at companies like Alphabet, Facebook, these are companies that get about half of their revenue from overseas. So if overseas trade takes a blow, technology is going to be one of the sectors that's most poised to get hurt. And you also need to look at sort of the move in the tech sector so far this year. It was up about 11% year to date until today. And, that really just tells you this is an area that people are going to be looking to sell given any reason. Perhaps a little overvalued by some measures, and just people looking to take some profits, maybe reinvest in some of these other areas that might be seen as benefiting more from a Trump presidency. And lastly, there's the more cynical view here, which is that it was people in the tech sector weren't exactly quiet about their distaste for Mr. Trump during the campaign trail. And there's a little bit of skepticism that he's going to treat them nicely, that maybe he's going to have some sort of a revenge agenda. I'm not sure if I'm willing to go that far, but there's certainly a lot working against technology today. And you saw all four of those FANG stocks. They're all down more than 1.9% for one day.
I'm thinking about Amazon CEO Jeff Bezos, who tweeted about sending Donald Trump to space after Trump said something negative about him owning the Washington Post. That said, financial and industrial shares rallied. I mean, don't all of these industries, aren't they, affected by trade issues and immigration issues as well?
Yeah, one of the big things to look at, though, is just sort of the specific things that he's said, since the election was completed. If you look at the financial sector, Dodd-Frank, he's talking about repealing that. That's going to remove a lot of regulatory oversight from this area. And also, you also also keep in mind that the probability of a rate hike in next month is very high, and that's going to benefit banks too. So it might not just be Trump that's affecting banks. People with money to burn, looking to get cash off the sidelines, would be looking at financials as a pretty appealing place. When you're talking about materials and industrials, those are sectors poised to really benefit from the increased infrastructure spending that Trump has long proposed, and it's just the sort of I guess pro-economic cyclical sector that is the type that would benefit from that sort of thing. And in technology, unfortunately, just weighing some of the brunt of that. And then also, it wasn't just technology, even though that was the biggest loser today. We did see, with the big spike in bond yields, we saw bond proxies like utilities and REITs get crushed today as well. So it's sort of a war under the surface of the stock market right now. The market was only up about 0.2%, but you have these huge moves, some dispersion we haven't seen since the financial crisis.
Interesting. All right, we'll continue to follow. Joseph Scioli, our Bloomberg stocks reporter, thanks so much, weighing in from New York. Meantime, Disney shares moving after hours. Shares of the world's largest entertainment conglomerate are now higher post-market after reporting fourth quarter results. Adjusted earnings per share fell 8% to $1.10 on revenue of just over $13 billion, both of which fell short of analyst estimates. The company said it was hurt by lower ad sales at cable TV networks, including its largest business, ESPN. But on the call, CEO Bob Iger said ESPN is losing fewer subscribers. Joining us now for more, Greenwood Capital Chief Investment Officer Walter Todd in Columbus, South Carolina, and with us from Princeton, Bloomberg Intelligence Media Analyst Geetha Ranganathan. Walter, I'll start with you. So the TV business generates more than half of Disney's profit. Programming costs are increasing. Are you concerned about this particular business getting squeezed?
Not really. I mean, the quarter just reported, as you said, was uninspiring, but I think Bob Iger got on the call and did his best impression of Aaron Rodgers and said, RELAX, relax, as it relates to the subscriber losses. He talked a lot about direct-to-consumer and using the BAMTech investment to do that. So I think that's why the stock initially was down and then turned around after he started talking on the call about that.
Shares trading up now 3% post-market. Geetha, would you agree with that?
Yes, I do agree. I mean, there was a lot of noise coming into this quarter because of some tough comps from last year, which had the benefit of an extra week. And so there was, the estimates were a little bit all over the place. So there was some noise there. But then, yes, I think Bob Iger did a very good job of allaying any fears in the minds of investors regarding the growth prospects for ESPN.
Now, Walter, let's talk a little bit about ESPN, because Nielsen last week reported ESPN losing over 600,000 subscribers between October and November. What's your take, even if losses are slowing, what is your take on the future of the business?
Yeah, well, I think ESPN remains one of the most valuable properties in media, and I understand there have been some subscriber losses. But again, Iger talked on the call about using this investment that they just made in BAMTech to go more direct to consumer. And I think that's going to really resonate perhaps with some younger subscribers that have gone off these multi-channel cable packages and can use it direct to the consumer. So I think the value is there, and I'm not really that concerned about it. I also love the diversity that Disney has. I mean, that's one of the beauties of the company, is they do have these other businesses that, while they have trouble at ESPN currently, they can offset that with an incredible studio slate coming up next year, as well as the parks and resorts in Shanghai due to break even next year.
Let's talk about Shanghai Disney. Obviously, now been open for a few months. Geetha, do we know how well Shanghai Disney is doing?
Yeah, so management has had great things to say about Shanghai Disney. As Walter mentioned, it's going to break even. That's what management said next year. They gave some attendance numbers. They said 4 million visitors in the first 4 months, which is very encouraging. Of course, they're not going to give guidance for the future. But so far, I mean, it's been a textbook opening for Disney, and it's resonating really well with the audiences there. And I think the other one thing that Bob Iger mentioned was the fact that they have some pricing leverage there. So it'll be interesting to see how Shanghai becomes a really important part of their international park operations.
It'll be interesting to see how the park does through the winter. Winter in Shanghai is brutal, having experienced it myself. Let's talk a little bit about the movie slate, Walter. What are you so excited about when it comes to upcoming releases?
Well, I think obviously the Star Wars franchise is front and center. They've got one coming out in a couple, I guess, next month in December, and then the Episode 8 coming out next year. So when you look out at Disney, one of the great things about it is the predictability of that earnings stream, because the movie slate's so planned out for 3 to 5 years in advance. On top of that, you got more Marvel movies coming out next year, and then they mentioned the Cars 3 coming out next year also. So just a really broad spectrum of movies.
Geeta, do you see, obviously Star Wars, but any of these movies in particular leading to greater merchandising opportunities and opportunities to expand them into other businesses?
I mean, that is something, Emily, that Disney has just done so beautifully well, taken all of these, all of their IP, all of their characters, and kind of monetized them across all the different segments of the business. You know, they have a very, very strong slate in 2017, an even stronger slate in 2018, with 4 Marvel movies and 2 Star Wars movies, apart from, you know, 3 animation movies from the Pixar and the animation studio. So just, you know, firing on all cylinders when it comes to all different parts of their studio business.
Disney CEO Bob Iger on the call, talking a little bit about the succession process. Is always a question that comes up given the CEO transition that will be happening in the near future. He says the succession process ongoing, robust, and new CEO candidate will come on a timely basis. Walter, any concerns about the future of Disney when the CEO is not Bob Iger?
Yeah, no, I mean, Bob's obviously been an incredible CEO. He's the 6th CEO since the founding of the company. So, yeah, I mean, that transition is going to be concerning when it happens. I'd love for you to ask Bob when you interview him if he wouldn't mind signing another 5-year contract. That would be great.
He keeps extending, so it's happened before. Walter Todd of Greenwood Capital, Geeta Raghunathan of Bloomberg Intelligence, thank you both. And stay tuned, more Disney analysis later this hour. We will be joined by CEO Bob Iger live from Disney headquarters in Burbank. Coming up, cybersecurity continues to be questioned under the leadership of President-elect Donald Trump. Can we expect to see a friendlier future with Russia? We'll break it down next. This is Bloomberg. Alibaba Singles Day has officially kicked off. Based in China, the 24-hour shopping frenzy has served as a litmus test for the strength of the Chinese economy. Sales are expected to hit a new record this year, the event bringing in $14.3 billion in 2015, 4 times more than Cyber Monday in the United States. Joining us now to discuss, Tom McKenzie on the ground in Shenzhen, China, the heart of Singles Day festivities. So, Tom, Alibaba has brought in celebrities from around the world, from Scarlett Johansson to David Beckham. Give us the lay of the land.
Emily, yes, and you know this event well, but they added up to the glitz and glamour again this year. As you say, the Beckhams were here plugging some of their own products. There was, of course, Kobe Bryant as well, and Scarlett Johansson. One sour note was the no-show of Katy Perry, the pop star, who cited family matters, though many were quick to point out that she had been clearly devastated by the Trump presidential win. So, yes, there was lots of glitz and glamour on stage last night. Jack Ma, the founder of Alibaba, came out and even did a magic trick. It is, of course, all about hyping this up, getting as many viewers as possible, as many customers engaging and trying to beat those records that you pointed to just now. Emily?
Jack Ma, known to do magic, karaoke. Alibaba did post $1 billion in sales in just the first 5 minutes. You know, if this is a litmus test for the strength of the Chinese economy, what's the verdict so far?
The verdict is pretty strong. In the first 5 minutes, as you say, $1 billion after the first 2 hours, over $7.2 billion US. That was more than the entire 24 hours of 2013. And behind me on the screen just a couple of minutes ago, the number was showing at around $9 billion. It is 8 a.m. here in Beijing, in Shenzhen, local time, so we're less than halfway through this event. So they are on course to beat their number quite confidently from last year. Analysts saying that if we see an uptick of around 45% from last year, that will be seen as robust given the overall slowdown in the Chinese economy. But the consumer has remained confident this year, and this, as you say, is another litmus test and gauge of the all-important Chinese consumer and their sentiment, Emily.
There's been a lot of talk about how a Trump presidency will affect business, will affect relations with China. Alibaba is an international company, but Donald Trump has, talked about ending a number of trade agreements with countries around the world. Any insight into how President Trump might impact Alibaba?
It has, to a degree, overshadowed the event, and we heard Bloomberg from analysts at Wedbush Securities saying that of all the Chinese internet firms, Alibaba would be most exposed if Trump did follow through on those tariffs, and it's very likely that if he did do that, China would respond as well. But there's also a note of caution from the people we spoke to on the ground here last night, saying that, look, we need to see what he does actually follow through with. And we also heard from the executive vice chairman of Alibaba, Joe Tsai, pointing out that trade between the two nations was increasingly important for jobs. And in terms of Alibaba, they have their AliExpress site that sells into the US from China, and then they have Tmall that, of course, sells high-end products from the US into China, and both of those would be affected if these tariffs would be put in place. But the analysts that we spoke to on the ground and members of Alibaba are saying they're playing a wait and see. They may, though, start to focus on emerging markets if Trump does follow through on some of these policies, Emily.
Okay, Bloomberg's Tom McKenzie on the ground in Shenzhen, China. A lot of uncertainty. We will, of course, be speaking with Alibaba President Mike Evans live tomorrow right here on Bloomberg, 10:30 a.m. Eastern, 7:30 a.m. Pacific. We spent so much time with Bob Iger. You'll have to catch my interview with John Chen, CEO of BlackBerry, at Bloomberg.com. We also talked about the impact of a Trump presidency on U.S.-China relations. John Chen did advise President George W. Bush, during his administration. Thank you so much for joining us. That does it for Bloomberg Tech. We'll see you tomorrow. Welcome back to Bloomberg Tech. Earlier today, I attended Techonomy's annual conference in Half Moon Bay, just south of San Francisco, where Bloomberg contributor David Kirkpatrick has pulled together an all-star list of speakers, including Facebook's Mark Zuckerberg, BlackBerry's John Chen, and Fitbit's James Park. The conference's main theme is how the Internet of Things, or IoT, will reshape products and services to create a more efficient world. I sat down with the man leading Verizon's IoT efforts, Mark Bartolomeo, and started by asking how IoT will impact the long-term vision for the wireless business.
We may not see individual growth of smartphones, but we'll continue to see the growth of the consumption of data, more and more data. And that's also an important part of our 5G investment, not only to improve service, but be able to move that data cost effectively and then also efficiently so we don't have those choke points.
So how do these efforts hit the bottom line, and where does revenue and profit come from?
So the revenue and profit comes from making our infrastructure more efficient. So as you're consuming more and more data, we have a cost-efficient infrastructure that gives you the ability to maintain margins and then continue to invest back into the network infrastructure.
We're talking about sensors and chips everywhere. Are networks resilient enough to support billions and billions and billions of tiny devices?
Yeah, let's talk about those tiny devices, because that's really where the growth is. We were talking about smartphones, and over the years with the investments we've made, those investments have been around investing in devices and communications to move huge volumes of data in short periods of time, the typical broadband scenario. And now what you're mentioning is it's about moving very, very small bits of data, probably from devices that have never been connected before, but supporting those devices over a very long period of time. So you're right, resilience is going to be a key issue. And
can the networks handle it?
And the networks can handle it. And we're going to have to stay in front of that growth curve and continue to make those investments.
Mark Bartolomeo there, Verizon Vice President of IoT, speaking to us from the Techonomy Conference in Half Moon Bay, California. Still to come, Disney CEO Bob Iger joining us live from the company's Burbank headquarters for more on the latest earnings report. That conversation is next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg.
I'm Mark Crumpton. You're watching Bloomberg Technology. Let's begin with First Word News. President Obama has asked Congress for $11.6 billion in additional war-related funding. The amount includes money to fight Islamic militants, sustain higher troop levels overseas, and help modernize Afghanistan's military. The request was sent to lawmakers for consideration during the lame duck session that starts next week. Former Vermont Governor Howard Dean's running for chairman of the Democratic National Committee again. Dean held the position from 2005 to 2009. On Twitter, Dean said Democrats need, quote, a 50-state strategy and tech rehab. Minnesota Congressman Keith Ellison also announced he'd like to be considered for the position. South Africa's parliament defeated an opposition motion to remove President Jacob Zuma. He's been facing a series of scandals, including possible government corruption linked to the presidency and his associates. The motion by South Africa's biggest opposition party was rejected after an often raucous debate in which rival lawmakers heckled and traded insults. British police say the driver of a tram that derailed in London has been released on bail. 7 people were killed. The man, who has not been publicly named, was arrested after that crash on suspicion of manslaughter. The tram came off the rails while rounding a curve in London's Croydon area yesterday. More than 50 people were injured. The tram won't be moved from the site until tomorrow. I'm Mark Crumpton. It's just after 6:30 p.m. Thursday here in New York, 10:30 Friday morning in Sydney. Paul Allen has a look at the markets. Paul, good morning.
Good morning, Mark. We're off to another bright start on the ASX. Shares already up about a third of 1% after the first 30 minutes of trade. And it's the usual suspects leading the gains. The miners doing well once again. BHP, Fortescue, South 32. The only ones weighing on the index really are the gold stocks once again, giving up some of those gains we saw midweek. The Aussie dollar is weaker meanwhile on US dollar strength, and the New Zealand dollar briefly weakened this morning. That's after the RBNZ Assistant Governor John McDermott said that the RBNZ was worried about the strength of the local currency and might be prepared to cut the cash rate again. Sticking with New Zealand, the NZX also showing some good gains early Friday afternoon, up 0.5%. We're expecting a good start on the Nikkei as well at the open. Keeping an eye on Toshiba reporting earnings later today, and Nexon, the online gaming company, reporting a 60% drop in third quarter profit. Also a big day in China with Alibaba's Singles Day going live, going to be 4 times bigger than Cyber Monday in the US. I'm Paul Allen for Bloomberg in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Emily Chang. Back to Disney now. Shares of the world's largest entertainment conglomerate are higher after reporting fourth quarter results. The company reporting that fewer ad sales hurt its TV business, which does make up more than half the company's profit, but it's now losing fewer subscribers at ESPN. Disney just wrapping up its earnings call, and our Bloomberg Daybreak America's anchor David Weston is standing by in New York for more with Disney CEO and chairman Bob Iger. Yeah, David?
We're delighted to be joined now by the chairman and CEO of the Walt Disney Company, Bob Iger, coming from his headquarters out there in Burbank, California. Bob, so you have your full year earnings as well as your fourth quarter, and you have yet another up year, both in earnings per share and in revenue. At the same time, I think you would agree that you got some headwinds that developed as the year unfolded. Give us a sense of where you think you came out in 2016 and give us a peek into 2017.
Well, 2016 was a tremendous year for the company for a variety of reasons. First of all, 14 and 15 had been record years for us, and we did even better in 16. So we continue to grow the company at a robust clip. In addition to that, the 2 biggest things that we had to accomplish in fiscal 16 was, one, bring Star Wars back. Our first movie, Force Awakens, came out in December, the first one since the acquisition of Lucas, and it was just a gigantic success. Over $2.1 billion in global box office, 3rd highest grossing movie of all time, and a critical success as well. And the second thing we had to do was to open up the biggest, most ambitious project that we've ever embarked on, and that was building Disneyland in Shanghai. We opened on June 16th. I'm proud to say that after 4 months of operation, 4 million people visited the park, and they're loving what they have experienced. And the prospects for that park in the most populous country in the world, I think, are really bright. So as we move to 17, we feel great about what we accomplished in 16. There is momentum in most of our businesses. We have a couple of headwinds as it relates to, comparability factors like the cost of the new NBA contract for ESPN and the fact that we don't have a Star Wars saga film in 2017. But we think that the company is headed in the right direction. We've talked about the fact that 17 is an anomaly and that it's a lower growth year than we've experienced since 2013, for instance. But
lost it.
Particularly given the fact that we will have absorbed that NBA deal. We'll have a Star Wars saga film. Shanghai will be well underway and startup costs will be behind us. And we have an incredible slate of other movies.
Well, Bob, as you suggest, one of the strengths of your company is the range of assets you have. So if one starts to miss a little bit, you've got another one to come on with a hit. But I think it's fair to say the media networks have gotten a lot of attention, particularly ESPN, frankly, in part because it's so successful and so large. But there are questions about the subscriber level for ESPN and some reduction in the subscribers. Can you bring us up to speed on where that stands right now? At what rate are you losing subscribers? Is that continuing?
Look, we've been eyes wide open, I'll call it, about what's going on in the television business overall. We've seen a lot of disruption. People are consuming TV on new platforms in very, very different ways, in new places as well. Mobile has become really important, for instance. We were candid a year ago about what we had been seeing at the time regarding ESPN subs. We've been seeing losses. A lot of it came from the adoption of cable light bundles that did not have ESPN in them. We decided that we would embark on a campaign, so to speak, to make sure that ESPN was included in any new light bundles that launched, and we've been quite successful at negotiating deals with distributors, particularly a lot of new distributors, to make sure that ESPN is included in the new packages that are coming out. So we are heartened by, one, a slight abatement in the loss of subs due to light bundles, two, the launching of these new digital platforms, which we think provide a great user interface and are very mobile friendly. We know ESPN is a great hand as it relates to their programming. We know that live sports is still really popular. And so while there are some challenges that are due to some of the disruption that we've seen, we actually believe that there are some solutions or some answers to some of the questions that people have had about what's going on with ESPN, and we feel good about our prospects.
And as you look out into 2017, do you believe that those new digital distribution alternatives can make up for the loss of subscribers in ESPN and resume the normal path of growth that ESPN's enjoyed?
Well, ESPN, save for the anomaly that is 2017, because of the $600-some-odd million of incremental rights fees due to the new NBA deal, which, by the way, we're not complaining about because we did a deal that takes us through the 2024-2025 season. We have a lot more rights, more games, more programming, and the NBA is what we consider to be an ascendant sport. It's growing in popularity. But there is an anomaly in 17 because of that. In 18, we believe ESPN will return to some nice growth again, and we believe ESPN will continue to grow beyond that. So our outlook for ESPN is positive. We can't predict yet just how big the impact will be from some of these new platforms that are launching, because they're just launching. But we feel good about the user interface. We believe that their pricing is right in terms of increasing adoption of those platforms. We think it provides a great alternative to people who thought the expanded basic bundle was too expensive, or to young people who weren't that interested in subscribing to what they consider to be cable television, but they like new digital platforms. And so we think that this is one of the best developments that we've seen in the multi-channel ecosystem in a long time. And we also know that everybody wants to launch with ESPN as part of their new package because of the popularity of sports and of ESPN.
On the subject of those new digital platforms, with the AT&T Time Warner deal, the old question about do you need to own the distribution in addition to the content is brought back full center. Does Disney need to own the distribution of those digital platforms or not?
It's interesting because I look at the AT&T Time Warner planned merger, as a distribution company needing to own content, as opposed to a content company needing to own distribution. I'm not going to comment on whether those synergies work or not, except that to me, it echoes you know, what we've seen, you've seen, I've seen for many, many years, and that is content is king. If you're a distribution platform today and you don't have great content, you better figure that out, because the consumer is interested far more in content than they are in how they get that content, although that's important too. For Disney, what we really would like to accomplish, and we see as a great opportunity, is how do we get closer to our customer? There are these tools that exist today that mine user data that do two things. They improve the user experience because of customization, personalization, more tailored, more contextual programming in advertising. And it also gives the distributor or the owner of the content an opportunity to monetize under more compelling circumstances. So one of the reasons why we made the investment in BAMTech that we did is we like the play of BAMTech in the sense that it is one avenue that gets us closer to the customer and gives us the ability to mine that data, sell directly, and grow our business. And we're going to continue to look with an open mind expansively at those opportunities. Well, do we have to own distribution? No, not as a company. We're doing quite well without it. Would we like to have the kind of distribution that solves the problem or provides us with the opportunity that I just described? Yes, we would.
So, Bob, one of your strengths as a CEO is you've always believed in going to scale. You don't like to do things in a small way. You mentioned the BAMTech investment. It's $1 billion, and it's a substantial company. But is BAMTech alone enough to take you to scale, or do you need something more to really take you to scale in this new distribution area of digital?
Very good question. Don't know the answer to that. It's a start. It's a step in the direction of achieving scale. Whether it gets us to the kind of scale we need or not, I think it's premature to answer that question since we haven't launched the ESPN branded product on it yet. But it's an important step.
So, Bob, you mentioned Shanghai. I can't possibly let you go without talking about Shanghai, because that was a personal project of yours, and it's a big project. Bring us up to speed on where that is. What do we know about Shanghai today that we didn't know 3 months ago?
Well, it opened June 16th to great fanfare, biggest investment that we've made outside the United States. It shows, by the way, in the product. It's great product, high quality, very entertaining, very original, and being very well received. So first 4 months, 4 million visitors. That did include the peak summer months. So we said on the call that people could infer, if you factor in that peak, those peak months, that should result in about 10 million visitors for the first year. By the way, we'd be happy with that number, but we're not providing guidance there. What we can say is that about 50% of the people that are visiting come from outside of the Shanghai region. That's a big surprise to us. We thought it was going to be well above 75% initially that came from Shanghai. And the fact that it's so balanced leads us to believe that word of mouth on this and the intent to visit from well beyond Shanghai is very, very high. So this has become suddenly not a local product, but a national product in China, a national tourist destination, which is what Shanghai is. That's really positive. We also know people are staying longer per visit, almost 2 hours longer. That's because there is a lot to do. We built, to your point earlier, we built to scale here, and they love the experience, so they're staying longer. That's not a bad thing. You want people to want to spend more time consuming your product. And so the combination of those and what we've seen from attendance and basically how the product is behaving in the marketplace, all really positive, which is why our outlook for that business is positive, why we decided, by the way, to expand even right away. We're building a new land, Toy Story Land, and the opportunity for expansion beyond that is pretty significant. I think you'll see a lot more.
Theme parks are so important to the Walt Disney Company, and as you say, you're expanding in Shanghai itself. Talk about growth. What have you learned from Shanghai about further growth in your theme park business, either in existing theme parks or even, I don't mean to press you on a new theme park already, but even expanding beyond Shanghai?
I don't know that we learned much more from Shanghai, other than the fact that the product works in China, and there are many other places in China that we could build theme parks. But it's premature for us to talk about that. It just reaffirmed what we already know. One, our intellectual property works great in theme parks. It is at an all-time high in terms of its popularity. We see that in all the brand research that we do. The fact that we have 11 franchises that did over $1 billion last year in global retail sales. So the intellectual property works. We know technology, when used in the park to create better experiences, really works. And if you were to visit Shanghai Disneyland and try the Tron attraction or Soarin' or the new Pirates attraction, which is vastly different than anything we've ever built, you'd see what I mean. You can take technology and create an immersive experience that is unlike any that you get, certainly in the home or anywhere else for that matter. And that's why we're continuing to invest not just in China, but across the board in that regard at our theme parks, because it grows our business.
Bob, this has been a remarkable week, not only because of the Walt Disney Company earnings, but also because we elected a new president that surprised a lot of people. It's early going, but I know the way you plan ahead. What are your first thoughts about how President Trump could affect the Walt Disney Company?
Well, first of all, I think that so far so good in terms of what I'll call transition, even though it's very, very early. I think both the president-elect, I was going to say the candidate, he's no longer the candidate, president-elect and President Obama have approached this really smartly. Be cordial, be open, understand that the most important thing here is America, not one party or another, not one ideology or another. And so let's be gentlemen about it, and that's what they're doing. That's great for the country. For the country to see that, it just instills confidence in our country and faith that the future is good, even if your ideology is not necessarily represented in the next president of the United States. So I like what I've seen so far, and I think the country's reacting well to it. It's too early to really predict what the policies of a new administration would mean for this company. Believe me, I've gotten briefed on how they might affect us, but way too early to speculate publicly. What I can say, though, is that we've been talking a lot as a company and lobbying a lot about the need for a new tax policy. The corporate tax rate of the United States is the highest in the world. It's not competitive. It needs to get fixed. It needs to get lowered, and loopholes need to get closed. And we definitely believe we would benefit from that happening, and the sooner the better. And I think it's something that's going to be addressed. Might ensue, really too early to say.
So finally, Bob, you're a student of the media. I mean, you've lived your entire professional career in the media. You know it and you love it. It's not too soon, I think, to start asking ourselves the question of the role of the media in this election. I mean, it strikes me that this is a very different media than was in existence even 4 years ago, certainly 8 years ago. And certainly Donald Trump took full advantage of that. Both in terms of being able to get access, particularly on the cable channels, but also in social media. Is the media starting to think about its role in future elections and what role it should be playing as the fourth estate?
There's a lot of hand-wringing about the media this week and its role in the election. And I think that hand-wringing is missing the point. And the point it's missing is that the media today doesn't look anything like the media of yesterday. We're living in a world where the sheer definition of media, and I'm talking about not the definition of what the industry creates, but the definition that the people create, is extremely different than what it used to be. How we get our news, what we consider news, how information travels, how fast it travels, it's vastly different. So I would argue that the media actually played a positive role in this campaign, in the sense that it was ever present, which media is today. It was sort of eyes on, cameras on, voices about everything that went on. Everything was exposed. Everything was subject to scrutiny by the new media. That can't be a bad thing. Now, did the media get it right in terms of predicting the outcome? No. I think that deserves some scrutiny by the media. And how did they get it wrong? But I don't think the manner in which the campaign was covered is necessarily something that deserves criticism. You know, you can always be reflective about it. That's fine. I think there's nothing harmful about that. But what is media today? It doesn't look anything like it did certainly 5 years ago, 10 years ago, when I started my career at ABC 42 years ago. It's just different. And I think it's time that those that follow the media from a critical perspective accept the fact that the media they are following today is vastly different than the media they used to follow, or maybe than they think they're following.
Bob, thank you so very much. That's the chairman and CEO of the Walt Disney Company joining us from Burbank, California. Now, back to you.
All right, David Weston, our Bloomberg Daybreak America's anchor with Disney CEO Bob Iger. Thanks so much. tomorrow on Bloomberg TV. Do not miss more reaction to Disney's latest results and the conversation we had with CEO Bob Iger. BTIG media analyst Rich Greenfield joins Daybreak America's 8:30 a.m. New York time. This is Bloomberg. Alibaba Singles Day has officially kicked off. Based in China, the 24-hour shopping frenzy has served as a litmus test for the strength of the Chinese economy. Sales are expected to hit a new record this year, the event bringing in $14.3 billion in 2015, 4 times more than Cyber Monday in the United States. Joining us now to discuss, Tom McKenzie on the ground in Shenzhen, China, the heart of Singles Day festivities. So, Tom, Alibaba has brought in celebrities from around the world, from Scarlett Johansson to David Beckham. Give us the lay of the land.
Emily, yes, and you know this event well, but they added up to the glitz and glamour again this year. As you say, the Beckhams were here plugging some of their own products. There was, of course, Kobe Bryant as well, and Scarlett Johansson. One sour note was the no-show of Katy Perry, the pop star, who cited family matters, though many were quick to point out that she had been clearly devastated by the Trump presidential win. So, yes, there was lots of glitz and glamour on stage last night. Jack Ma, the founder of Alibaba, came out and even did a magic trick. It is, of course, all about hyping this up, getting as many viewers as possible, as many customers engaging and trying to beat those records that you pointed to just now. Emily?
Jack Ma, known to do magic, karaoke. Alibaba did post $1 billion in sales in just the first 5 minutes. You know, if this is a litmus test for the strength of the Chinese economy, what's the verdict so far?
The verdict is pretty strong. In the first 5 minutes, as you say, $1 billion after the first 2 hours, over $7.2 billion US. That was more than the entire 24 hours of 2013. And behind me on the screen just a couple of minutes ago, the number was showing at around $9 billion. It is 8 a.m. here in Beijing, in Shenzhen, local time, so we're less than halfway through this event. So they are on course to beat their number quite confidently from last year. Analysts saying that if we see an uptick of around 45% from last year, that will be seen as robust given the overall slowdown in the Chinese economy. But the consumer has remained confident this year, and this, as you say, is another litmus test and gauge of the all-important Chinese consumer and their sentiment, Emily.
There's been a lot of talk about how a Trump presidency will affect business, will affect relations with China. Alibaba is an international company, but Donald Trump has, talked about ending a number of trade agreements with countries around the world. Any insight into how President Trump might impact Alibaba?
It has, to a degree, overshadowed the event, and we heard Bloomberg from analysts at Wedbush Securities saying that of all the Chinese internet firms, Alibaba would be most exposed if Trump did follow through on those tariffs, and it's very likely that if he did do that, China would respond as well. But there's also a note of caution from the people we spoke to on the ground here last night, saying that, look, we need to see what he does actually follow through with. And we also heard from the executive vice chairman of Alibaba, Joe Tsai, pointing out that trade between the two nations was increasingly important for jobs. And in terms of Alibaba, they have their AliExpress site that sells into the US from China, and then they have Tmall that, of course, sells high-end products from the US into China, and both of those would be affected if these tariffs would be put in place. But the analysts that we spoke to on the ground and members of Alibaba are saying they're playing a wait and see. They may, though, start to focus on emerging markets if Trump does follow through on some of these policies, Emily.
Okay, Bloomberg's Tom McKenzie on the ground in Shenzhen, China. A lot of uncertainty. We will, of course, be speaking with Alibaba President Mike Evans live tomorrow right here on Bloomberg, 10:30 a.m. Eastern, 7:30 a.m. Pacific. We spent so much time with Bob Iger. You'll have to catch my interview with John Chen, CEO of BlackBerry, at Bloomberg.com. We also talked about the impact of a Trump presidency on U.S.-China relations. John Chen did advise President George W. Bush, during his administration. Thank you so much for joining us. That does it for Bloomberg Tech. We'll see you tomorrow.